Hi guys, Will here, and in today's video we're going to explore the concept of risk to reward ratios, along with why it's so important to understand these and to use these within the edges that you trade, because your success and your profitability really do rest on them. And just very quickly, before we dive in today, if you are struggling with your trading or you'd like to know more about how mechanical edges are traded, I've actually put together a free video course for you that will map out and explain everything in detail, along with walking you through exactly how mechanical rules actually work. If you'd like to watch that after this video, I'll pop a link to that in the description and you can click through and watch that straight away. Hi guys, Will here for WB Trading and welcome back. If you are new to the channel, please do hit that subscribe button and tap the bell icon so that you don't miss any of the free content that we share with the trading community here on YouTube. Anyway, let's get straight into today's video. Now, what is a risk to reward ratio? It's simply a calculation of how much a trader is willing to risk on a trade, alongside how much a trader aims to profit on that same trade. Okay, so for example, if a trader is planning to take a trade and only wanted to set a stop loss at, let's say, 5 points and set a take profit at, let's say, 20 points, the risk to reward ratio would of course be 1 to 4, or in other words, you're risking 5 to make 20, i.e. you'll take a -1R loss if you're wrong, or take a +4R win, 4 times your risk if you're right. Fundamentally, as traders, we want to maximize risk reward whilst managing and capping our downside at all times. The majority of traders out there take small wins and yet large losses, don't they? Actually giving the market an edge over them. Profitable traders, however, do the opposite of this, only ever losing small, yet winning big, gaining an edge over the market, consistently pulling money out of the market as a profitable trader. And here at WB Trading, the 4 key strategies that we trade provide this. Wins that outsize losses in line with each strategy's win rate, providing an edge over the market when the strategy rules are followed. And here's the thing that many traders don't understand. Okay, the greater the potential reward in regards to win size that a strategy offers, the more losses you're actually able to safely take and actually withstand. That's the idea here. Use good risk to reward premises to put the odds in your favor. For example, let's imagine for a second that you had one of our strategies and you were consistently gaining trades that offer a 1 to 4 risk to reward ratio. Okay, you could lose 3 trades, win just 1 trade, and still come out ahead of the market long term. It's not about winning every single trade, and that right there is having an edge. One thing to understand though is that typically the larger the win size, the lower your win rate, as the two do actually line up together. And as such, trading psychology is incredibly important for a trader to understand, so that they can respect the fact that whilst they may take more losses than wins, due to the size of the wins, this is actually irrelevant. On the subject of trading psychology, it's important to know what works for you, either a strategy with a higher win rate yet that produces smaller wins, or a strategy with a lower win rate that produces larger wins. And as an example, personally, I prefer the latter. So I've never minded taking small losses in sequence, as long as I know that when I win, I will win big. Sometimes extremely big, producing double-digit R returns, making back many times what I've actually risked on that trade. Now, you'll need to decide on your own risk tolerance here. And as a side note, having a trading coach or a mentor can be helpful here to keep you focused, keep you on track and executing well long term. Someone to call up when you're unsure about something, who's been where you are and achieved what you want to achieve. The aim of the coach would be to handhold you and to help you determine whether you prefer, let's say, one or the other type of strategy, as we've just discussed. And it's why we actually provide this coaching for our clients here at WB Trading. And from there, your coach can help you to identify your strengths and your weaknesses, and can also help you to build a customized trading plan, taking into account whether you want to be a day trader or a swing trader, for example, along with the benefits and drawbacks of each. And a coach can actually also help you with suggesting several strategies to you of the 4
that we actually trade here, depending on your time availability and your time zone too. So what we offer, it is really a holistic, done with you approach, really. Again, the type of risk-reward ratio that a trader should use will depend on the type of trader that he or she is. It would be ideal, wouldn't it, if we could always identify trades that offer a very high level of reward for very little risk. But that's just not the reality, unfortunately. I wish it was. From my experience in helping traders improve their trading performance, I do often come across traders that are, as we mentioned earlier, risking a larger amount compared to the reward that they're actually receiving for taking that risk, giving the market an edge over them. And the scary thing is, many traders are trading this way without even knowing it, actually, without even knowing that they do not have an edge. The market has an edge over them. And the whole point of having a stop loss and keeping risk managed is not only to protect capital, but also to, well, get you out of a trade when the position no longer makes any sense. And sometimes the point where the trade stops making any sense can be much farther from the opening market price than it is a safe exit point, for example. And trading like this ends, well, badly, very, very badly, for traders who decide not to use a stop loss. In fact, I literally had a call with someone wanting to work with us a few days ago now, earlier this week, who was holding open positions without a stop loss that were against him by just below 50,000 US dollars. Yes, his account was in the red via open positions amounting to a loss of $50,000, all because he was trading without an edge, without managing risk, and without having clear rules in place. That is the true cost, the hidden cost of remaining uneducated. It is thousands, if not tens of thousands, if not hundreds of thousands of dollars. And people say that trading education is expensive. When it comes down to it, it's up to you as a trader to figure out what type of risk-reward ratio you want to use, along with what type of strategy you want to use. Again, either higher win rate, yet smaller wins, or lower win rate, yet larger wins. And by working with us here at WE Trading, you'll learn both. Remember, you should always avoid having your risk be bigger than your reward, particularly if you are a beginner without a strategy to follow. The important thing is that you use a ratio that makes sense for your requirements and your goals. Okay. Now, to conclude, again, be disciplined with your stop loss and never widen this based on emotion, because you will quickly, very quickly find yourself very much in the red, like the trader that we just talked about. Cut your losses early and let your profits run. Easier said than done. I know, we've all been there. But this is where success as a trader lies. It really does. Now, my advice would be remove emotion and the guesswork altogether by using mechanical rules. Follow these to a T, along with managing risk, and with that, you will thrive as a trader. You really will. Anyway, thank you for tuning in, and I'll see you next time.